Hello everyone and welcome back. In today's video, we discuss stocks, commodities, and cryptos, and we talk about what the Federal Reserve has just done in the US economy and how that floats through all of these markets around the world. 50 basis points was the rate hike. It was what the market expected. And when the market doesn't get any new information, what does it do? It rallies. But will it sell from this point, or will it continue like it did in March? Let's take a look at that now together. See you soon. Well, welcome back everybody to our daily show here where we talk everything to do with stocks, commodities, and cryptos. If you like any of those markets, please subscribe. And if you enjoyed today's video, make sure to smash that like button. Let's talk about the markets closed now, 4th of May, 2022, in terms of what the FOMC and the Fed have just done to markets. So they've lifted the rate by half a point. That is 50 basis points. This is exactly what everyone pretty much expected. Nothing out of the ordinary. Well, that's theoretically good news in terms of the way the market sees it anyway. Powell says inflation will be unpleasant in terms of the battle. And he says that the Fed chief says no bigger rates are not on the cards at this stage. So basically that means that any of those 75 basis point calls have been taken away. Again, taking away some of the fear that the market has. If we look at the statement, there's a lot to go through, but realistically, it's a lot of copy paste, which tends to be the thing that the Fed does. We'll use all the tools, blah, 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 was obviously the common thing in 2020 and 2021. Now we talk about, a whole bunch of copy pasting, everything's hard. And then we talk about here. So it says the committee decided to raise the target rate range for the federal funds rate to 0.75% to 1% and anticipates that ongoing increases in the target range will be appropriate. Okay, so they're going to raise rates further. Of course, we already expect that though. They've also decided to begin reducing its holdings of the Treasury securities, agency debt, and agency mortgage-backed securities on June 1. Again, mostly expected by the market. So the market rallies into this event. But what we'll talk about in today's video is not so much the rally and the current raising of rates, it's what happens if the Federal Reserve tries to reverse this decision in the future. That might surprise you quite a lot. So let's talk about fear and greed index here. Fear is still high in the markets according to these indices, but it's starting to rise. That is, it's starting to look a little bit less fearful than it was. It was in extreme fear at the beginning of this week at one point. Now we're back into just kind of the fearometer, that area there. So we mentioned the idea of soft landings in the future. When the Federal Reserve starts to do a rate hike cycle, like they've done in the past, they tend to stuff it up. That basically means that they can't unwind it. In fact, only 1 in 4 attempts of trying to unwind this potential interest rate hike is successful. And a lot of the time it causes recessions. Now, as we know, this could be a massive thing in the future if markets end up going bullish. And while we're going to be here in 2022, up, down, and all around due to midterm years and the nature of how they trade, keep this in mind. It's a super important point. And I think if you bring that together with some of your lead indicators to do with crashes, you may be able to see something in the future that might really surprise you. And I think that's what we're going to be looking at. It's one of those lead things that we need to watch in the future. When the Fed try to unwind this, if we get other reasons to potentially know that there are market conditions that are really bad, a recession could be coming. If we're not already in one, which obviously some people believe. Let's move over here to, and there's rightfully so why they could believe that. Let's move over to what actually happened in the market. Now, this does not tell the full story. It looks green on the surface, and it is, and it's done very, very well. But it was really down here early. I mean, it went down over 1.5% in the Nasdaq, and then it rallied. And then, of course, we saw the rate hike, and then we saw the Jerome Powell come out. Boom goes the dynamite. All of a sudden, repeat of March, huge gains. Nasdaq up 3.41%, S&P 500 up 3%, and they all went into our key resistance that we were discussing. So realistically, the last 24 hours played out to the T, what we all thought here on the channel, and congrats to you guys who did well there. Let's move over to the sectors. What was it all about? It was all about taking as much risk as possible throughout the day. They were buying up all sorts of risky kind of assets that they've smashed recently. Solar, clean energy, technology, semiconductors, they were the favorites everything that's been bashed recently was purchased up by the street. Let's move over also to what happens next after a basis point hikes like this. Now, 50 basis points is not usual. This is a very aggressive one. It's actually the first time it's really happened in more than 20 years. So we have to go back a lot of history to get the data during the 70s and 80s. And you'll notice here, it's not really necessarily that good in terms of when the Fed funds rate changed significantly. The next 3 months, only 61% of the time it was really bullish. And then even after 12 months, only 55% of the time was it even up. So this is what people are starting to discuss. Are we in a market that's going to be up, down, up, down, up, down all year? Well, I think we've already answered that question in many ways. In general, you expect that from these types of years, that is midterm election years. They're not traditionally very bullish. They're up, down, and they're more of a trader's market and investor's market at certain points. Let's talk about when we don't want something to happen. If you don't want a recession to occur, you obviously don't want the S&P 500 to go underneath 20% this year. If it does, usually it's statistically more likely we're in a recession. So just remember and keep that in the back of your mind. It hasn't happened yet. Yes, it has happened on the Nasdaq, but that's a different market to the S&P 500. The S&P 500 is the one we need to watch there. So keep that in the back of your mind. Q1 earnings still pretty good, 74%. It is dropping by the day here. That is, earnings beat rate is starting to decrease, but we've got the lucky number, 888 beats versus 317 misses. So still pretty positive here in terms of the current earnings season. We've got some big ones coming up. We've got Shopify, we've got Crocs, a stock that got beaten down very heavily this year. We've got Datadog, another one that's popular here with some traders, and we've got Cloudflare, Block or Square, and DraftKings, etc. still to go this week. So some big names, mostly in the hyper stock market, that is high ratioed stocks that have come under, in some cases, down as much as 80 or even 90% on some of these stocks. Cathie Wood not having a good time this year. So the Federal Reserve rate came out, the FOMC statement came out. What did that do with fear in the market? Well, fear significantly dropped. It went back down all the way to 25. Now, a lot of VIX traders are going to be looking at this and saying, well, I think there could be a bounce here, Tom. And you could be absolutely correct. So let's look at some of the reasons why that may happen. And while everyone's feeling all euphoric, possibly the next 24 hours of trade actually might be negative. Let's take a look at some of the facts. The US 10-year is still hovering around 3%. So the market-led rate, that is the 10-year, really decided by the market, held quite high. However, the 2-year rate came down relatively significantly. Look at that. That's a weekly chart there. So it actually dropped a little bit here after Jerome came out. Maybe the market was expecting more rate hikes out. I think it was right in expectation, and the market's a little bit frothy here. So watch the 2-year moving forward over the next couple of days. If this starts to significantly drop, that again could be slightly positive here for stocks, especially risk-on style stocks. The PCC put-call ratio is still very high, above 1, and that's basically showing that there's still a huge amount of fear. And in general, the short-dated options in the market right now are hugely defined by puts. That is, there's a lot of people that went negative this week, bought puts. That may be you. Unfortunately, when you hit these levels, like we discussed in the past, and we hit extreme levels of fear, it pays to usually not go with that concept, because that means that the market is due for a bit of a pullback and it will go opposite to what you think, contrary to a lot of people's beliefs out there. Unfortunately, they like to create maximum pain. That is, the market makers, the market participants, the big traders. Dollar index did drop, could signify that some money is moving out of DXY and of course into the SPY, into the Nasdaq, these types of things. So that's good news, I guess, if you're looking at rally on. It's not to be confirmed that dollar index is going to tank or anything yet, but certainly the first new low and the first sign of weakness that we've seen in quite some time. It's what we suspected here on the channel would occur, and it has done so. That's led to gold also having a nice little buy up here. And if we look at this on a daily, it may have just started to turn the corner. So I think gold's starting to look a little bit better here. I've said a few times that gold tends to react more positively actually to deflation than inflation. I know that's contrary to a lot of people's belief, but it does actually do that. And with the dollar index, if it continues to weaken, what do we expect gold to do? Well, I think you would expect gold to continue to go bullish here and feel a little bit better, especially if inflation is decreasing. Again, we don't know that, but if it is, that may represent itself into gold here. So watch this gold chart. It did break out here. We saw that kind of maximum pain concept down in these lows, and now it's starting to try to make its way back up. So gold looking a little bit better here on the last 24 hours of trade. We'll move over now to US oil. US oil also increasing, now struggling with that 108 resistance level, previous resistance here. It's tried to break through a few times and keeps rejecting from it. I'm not won over by the oil trade. I've told you guys a few times, I'm not trying to buy this at the moment. And a few reasons have got to do with this. But I do know that, of course, the news coming out of Europe, which is, bans on Russian oil, etc., and all these other things, that technically is positive towards oil. But I think we do have an OPEC meeting coming up as well. So there will be risks here. And I would rather wait to see more because we haven't broken through this high. I would prefer to do that. We've just kind of broken through the trend line down, not this high yet. So we probably want to watch a little bit more here and see on oil, though some of you will be bullish, and I don't think it looks terrible if that's what you're doing. Let's move over to some stocks. We'll talk about Tesla first. Tesla rising up here, and it's doing quite a good job. Of course, 977, huge resistance. That may be reached in the next session on the open. We'll find out, I guess, in the next session. But any pullback here, I would think is going to be met by buy demand. And of course, if we breach this resistance, I wouldn't be surprised at all to see some sellers come through here. Huge levels of previous support. You would think it's going to act as resistance, and it's certainly something that we're watching in the charts. And I think something you've got to put on the charts themselves. Now, we've recently been mentioning Facebook has been good, and we'll actually go over here just to show. One of the reasons we thought Facebook was good because it broke out of its relative performance against the other FANG stocks. Facebook's been a horror show. Let's face it, I don't even like the stock. Meta, I don't even know what the hell it's called anymore. But the thing is that it has been a horror show. It's been one of the worst performing, if not the worst performing, next to Netflix in the original FANG, which isn't even really a thing anymore. And it's currently rallying. So we mentioned that the other day, and that the main reason why was because the market went so negative and there were so many puts underneath here that were entered by retail that when the earnings result came out, when we knew what the market wanted to do, the market said, hey, you know what? Whoa, we're going bullish. We decide that this earnings result's better than what the price that it was. So now it's at fair value. Let's go up. And that then triggers in a momentum style trade, which triggers usually relative outperformance for a while into the next resistance zone. And that's what Facebook, I believe, is doing right now. It's why we bought it up. And look, the last session, 5.37, was it the biggest mover of the day? No. But let's put it against some of its peers. Microsoft up 2.91, Apple up 4.1, pretty good. Amazon up 1.35, and Google up 3.76. So realistically, it was up pretty damn well against all those other big names. And I think a lot of this has to do with the momentum of the switch, the bait and switch after earnings. So always pay attention to that type of thing. Let's move over to Apple here. And Apple also had a massive day, as we mentioned. It's kind of hitting a resistance, being the last sell-off zone, but it is breaking through a bit of a downward trend here. Again, it made a new low, instantly rallied through that. Probably a few people went short here, getting trapped into positions. And it does look like on the surface that Apple is improving as a stock into its dividend payment very, very soon. Earnings is out of the way, rallies are on in the rest of the market, and in general, Apple's in one giant big distribution or accumulation, whatever you want to call it. Could be either, really. And realistically, at this stage, it does look a little bit more bullish than bearish, but I'm going to pay attention to the Nasdaq over this. Let's move over to the DAX. As we mentioned, the downward trend line here smashes straight into that as resistance for the next session. Interesting level. Do we expect some sellers to probably have a go at it here? In general, yes, because most people are going to try here. So we might even consider some consolidation or even a little drop. But if it does break through this, it's kind of saying that risk is on across the rest of the world, along with obviously the US. IWM is very similar, downward trend, broken through, bit of consolidation. There's the Fed's statement and obviously Jerome Powell, bam, we go straight into a resistance. And again, we have previous supports over here on the left-hand side that are causing all sorts of pain. So we're at resistance here. I think IWM is not an easy trade, but it does show us whether the rest of the US economy, the smaller cap stocks, want to go long. And in this case, well, it's looking better than it was. Let's now talk about the two big markets. We'll start here with the Nasdaq. So the Nasdaq just went boom, just like the S&P 500, boom, straight into resistance. And what a great level for it to hit into the close. I'm sure many people were taking profit here. I don't blame them at all. It hit exactly where we thought it would go to, and it certainly did a good job. And I think this is where we expect some potential weakness to come in. Now, oftentimes markets will try to rally, very, very hard like they did in March. But this was a pretty large move, and I wouldn't be surprised at all to see the market come down first and then move back up. And if it does then move through this resistance, I feel like the bears at this stage will be losing control of what they've done a very good job at, which has been shorting this market. So the next 24 hours, again, becomes pretty important into the options expiration, which we'll talk about in just a moment. But I wouldn't be surprised at all to see some sellers try to commit themselves here. And this is one of those days that I would come into the market, and if it's sitting around this level in the open, I would watch the way it interacts with the next zone up, or even how it interacts down. And I would obviously look for potential shorts. And if it was going long and then it instantly reversed back down, could that be a trap set by Wall Street to then reverse and then most possibly even go long later? I think this is a very important zone, and we need to watch it and need to put a lot of emphasis on it in the next day. The same thing goes for the S&P 500. There's so much at stake here. What have we done? We've come back up to the 4,300, exactly as you guys thought. 4,300 resistance, bam, slam into that. We've also got the 20 moving average. Okay, exponential moving average, resistance, first time it's touched, kind of gone mean reversion. So it's gone back to the mean reversion point. Pretty important. Let's now scroll down to the 4-hour here. What's going on here? Well, we have resistance, we have resistance, we have resistance, and we have a big bull move. We've also broken through a downward trend that was present on the 2-hour, which we had in the previous video, and we talked about this. We talked about the coiling, we talked about the 4,200, and we spoke literally about the 4,200 becoming a 4,300 straight after, or probably going to happen after the Fed result, which is exactly what happened. Caused some scare in the morning, then boom, slingshot straight into it. Could we see sellers here? I think there's a high probability that you do, because this is a 1, 2, and a third time touch. Again, traps could be set here. Markets could pull back down, possibly even to the 4,200 or 4,220 or something in here. And then maybe we see buyers recommit themselves at this point. But it kind of makes sense. Again, a lot of bullishness is present. And if we get that and that, wouldn't that be a really fantastic trade? More traps set here, more people going bearish, and then all of a sudden we go bullish, creating possibly an inverse head and shoulders, as many of you will see it, or an accumulation base, as others will see it. It doesn't matter. The point is that you'll basically see those kind of points. So let's have a look at max pain. Where's that sitting at for the close this week? Well, theoretically, max pain sitting at 428. We don't really use max pain every week or anything like that to figure out where the market's going to close. This is where, if all of the options expired, they're in the market perfectly. That is, Wall Street makes optimum money from selling them to us, the retail traders generally. They would close it at 428, pretty much where it is right now. That would be where it sits. Now that's going to change, but I think down here is where the importance is. Look at these strikes. Look at what retail did this week. Huge amounts of orders at 395, huge amounts of orders at 400, huge amounts of orders at 405. Lots and lots and lots of puts in comparison to the amount of calls, yeah? So you can see the fear was really spread. Everyone went bearish, and then the market says, ha 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 ha, suckers, we go the other way. And unfortunately, we suspected that may occur when we started to see how negative everybody was in the markets. So right now we're at resistance. I still could see a sell or rip here in terms of movement down, but I'd also be looking for potential turnaround stories if it does sell. we'll come back, we'll have a look in the next session. Obviously subscribe if you haven't already, so we can go along with that journey together. Let's now also take a look here at Bitcoin. So Bitcoin halving, I think we're kind of in a bit of a crypto winter here. People just don't seem keen on the coins anymore. And it seems to be following a very similar path to after the previous ones. Now, a lot of people say, oh, this halving event stuff's finished. Well, we'll find out about that. I think between 900 and 1,000 days could be an optimum kind of zone if you like Bitcoin. But let's have a look at the movement over the last 24 hours. So we've gone back to a 20 moving average. Okay, interesting. That's forming resistance. Cool. We've got a downward trend line that got broken with a double bottom down the bottom and its previous support. So I guess there's a bit of risk on going into the crypto markets right now. And if you look at the 2 hour and 1 hour, it becomes pretty apparent that seems to be what's occurring. That was a nice breakout. Of course, if it pulls back, we expect some kind of rally demand through these points. And yeah, at this stage, as long as the Nasdaq holds up, it seems to be risk on in the crypto markets. Let's take a look at Bitcoin shorts, continues to decline. So this could be big whales dumping their short positions, ready to go long again. Again, it's a positive, so it's more of a positive. We commented on the last 24 hours, so we've already been following it. And I think it's worthwhile keeping in the looks. If you haven't already, follow FX Evolution on Twitter and also come into our Discord community. Well, we've got almost 8,000 people in there sharing ideas, sharing economic charts. Many of the charts we post here are actually shared from the community, and I just look at them and I go, yep, that makes sense, and I add it into the day. So yeah, come and join us. The links are in the description below and in the comment section. So make sure you jump on over into the Discord. It's a great community, and I think we've got the best one on the internet for traders out there. So definitely come and join us. Let's move over to some other things that are going on right now while we have non-farm payrolls. So expect a little bit of blockbuster fireworks in the morning, 8:30 a.m. New York time, non-farm payrolls, unemployment change. Let's find out what that does. Another huge event. And often leading into these types of events, markets can actually slow. So again, we might see some risk off, and then depending on this number, maybe we see some risk back on. So keep a lookout out there, everybody. I wish you the best in the markets right now. And of course, subscribe, smash that like button if you enjoyed today's video, and we'll see you in the next one. Bye for now.